Hello, everyone. I hope that we're doing well. Today, we'll continue our discussion on the double entry bookkeeping principles. In the previous recording, we had, introduced ourselves to accounting circle. We've distinguished between cash and credit transactions, credit and debits, and we had looked at recording transactions in its own. So particularly within the, accounting circle, we had done identifying transactions and recording of journal entries. In this particular video, we're going to be posting transactions to the ledger account. So we're moving now to the third item on the accounting circle, which is posting transactions into a ledger account. Let's go. So when we're discussing the double entry principle, introducing ourselves to it, we said, for every credit side, for every credit entry, there is a corresponding debit entry. So that dual aspect of bookkeeping. So, when there is a credit entry, there would be a corresponding debit entry, and the two sides of the account would have to be equal. Illustrating that in the ledger account would have, so this is a ledger T account, where we'd have the debit side. We have our debit side, and also we have our credit side. You just have on both sides, the date and the details and the amount of the transaction which you want to record in the T account. Okay. Let's give an example to test ourselves. If you recall from what we had discussed in the first part of this recording, we had mentioned, various processes we needed to follow when we wanted to record our accounts. And we referred to the 5 groups of accounts, which is the assets, the expense, the income, liability, and capital. So let's look at this example. We have a business here. We said your business bought a motor vehicle for £10,000 on the 1st of December 2009. Paying by check. So we said the first step would be usually to identify the transactions. So what are the transactions? What are the key transactions that have taken place? The first one you agree with me is that there's been a purchase of motor vehicle. A motor vehicle, you would agree with me, is an asset. But then this motor vehicle that is worth 10,000 was paid using check. So there is also a bank. It means there's a reduction in the amount that is in the bank. Bank is also an asset. So we identify those two those two key elements of this transaction, which is the motor vehicle as well as the bank. Motor vehicle is what type of, where would we classify that? It's an asset. It's an asset. It's an asset. So if you haven't listened to the video where we're introducing ourselves to basic accounting terms, please refer back to that video where we said, an asset is a resource that has been controlled by the entity from which you expect future benefits from. Okay, so this is an asset. Motor vehicle is an asset. I would say when an asset is increasing, as in this case, our business is acquiring a motor vehicle, there is an increase. So we'd expect to have a debit. Bank is also an asset. It's also a current asset. Why motor vehicle is a non-current asset. So bank is a current asset, and we said when there is an increase in an asset, we debit. But if there is a decrease in that asset, they should be, it should be credited. In this case, because we drew 10,000 by check to pay for the motor vehicle, the amount we have in our bank account has now reduced. So meaning that there is a decrease, and in that case, there should be a credit to the bank account. So now we have 2 accounts that we're going to open in our ledger. So we open T account for both motor vehicle as well as the bank, and then we'll post the transactions. So on the 1st of December, we have motor vehicle. So the motor vehicle on the 1st of December 2009, we have our 1st of December. Bank, motor vehicle account. So our motor vehicle increased because there was a deduction in bank. So we'll post it this way. You debit your motor vehicle account because there has been an increase in motor vehicle, but then there has been a decrease elsewhere. Do not forget our dual principle. For every debit entry, there has to be a corresponding credit entry. What reduced to bring about this increase in motor vehicle? It was bank, and then we have our bank account here. Also on the 1st of December, but this time around, we're coming to the credit side because there's already been a debit entry. So on the credit side, there was a reduction in bank as a result of motor vehicle that was bought. So here we have our motor vehicle. And that's it. Simple, straight and forward. Simple, straight and forward. And this is what we're doing with the double entry for our eligible account. So let's try another example. You might want to pause the video and try this yourself. It says the owner starts the business with £2,000 paid in cash on 1st July 2020. Do you want to pause and try that? First thing you want to do is identify the transactions. Say identify the elements of the transaction. We have starting a business, so that tells us that there's something like capital here. So there's a capital of 2,000, and this capital, this business that you're starting the business with is taking away cash, is bringing in cash. Is bringing in cash into the business. So there's capital as well as cash. In some other examples, you would have that maybe the money was paid into a bank account. In that case, it would be a bank. So in this case, we have capital starting the business and we have cash. So we have that our capital has increased because you've brought in capital into the business. So capital, your ownership, when we're discussing those accounting terms again, we defined what capital is. So your owner's contribution in the business is the capital that has increased, and that is 2,000. And in our class of account, if you remember, we said if there is an increase in capital, so if I take a step backward, we said if there is an increase in capital, we're going to credit, but if there is a decrease in capital, we're going to debit. And we mentioned in the last video, various ways that capital can be decreased through loss, through withdrawals, and all of that. So let's go back to our question. So here we have increase in capital. So we're going to credit capital because there's been an increase in capital. But that increase in capital has also brought about money within the company, within the business. Now we have cash in our hands. It means cash has also increased. Cash is an asset. Increase in assets, we say what we're going to debit it. So we're going to debit cash account and credit capital account. A dual principle of bookkeeping has been fulfilled that way. So we open our cash account, we open our capital account. Cash account needs to be debited because there was an increase, but we're debiting cash as a result of what? Capital. So our narration here will be capital. So we start with 1st of July. 1st of July, capital, 2,000. We also open a capital account. So what this tells us is when we look at cash and we see capital there, we know that if we go to capital account, we'll see the corresponding entry in the capital account. So we open capital account. Capital has increased as a result of an introduction of cash into the business, right? And then capital account is going to be credited. Narration would be cash, and that's it. Okay, let's try this. You want to pause the video, please, and try this. The owner bought a computer for the value of 700 by bank transfer on the 4th of September. So there is computer, you identify this, and there's bank. So the two accounts, computer, bank. Computer has increased, so increase in assets will be debited. Amount in the bank is also, is an asset, but this has reduced, so it will be credited. So we have two assets here, computer and bank. Bank has decreased because of a reduction of £700, but we now have more computers with us. So the assets, computer, non-current asset computer has increased. So you open a computer account and you open a bank account. So computer account, you're going to put your narration, bank, you put that on the debit side, and then the corresponding entry will be bank, and you also put your narration, computer, on the credit side. So I hope we're getting it. We're getting the the logic in it. For every debit entry, there is a corresponding credit entry. Let's try another example. You might want to pause the video to try this. Ahmed sold sofas worth £10,000. The customer paid him in cash. So Ahmed is into the business of selling sofas. So he has made a sale of 10,000. So we have sales, and then here we have customer paying him cash. So the two elements of the transaction is we have sales and we have cash. So you identify those two, sales and cash. Increase in sales, you're going to credit. Increase in cash, you're going to debit, and that fulfills our dual entry principle. So you debit and credit side. Open your cash account. You're going to debit your cash account because of increase coming from sales, and then you're going to also credit your sales account because of increase in sales. Another example, do we have another example? No, so that will end with that, example. But I hope we understand what we're saying. For every debit entry, there will be a corresponding credit entry. So the first thing is for you to identify the element of the transaction. Once you're able to identify the element of the transaction, determine if there's been an increase or a decrease, and then that will tell you what you should do, whether you should debit or you should credit, and then you can open the tier accounts. Okay, so you can use this, to do some practices. So you have Salma set up a business by paying 10,000 into a business bank account. So here you can already identify the account. The account will be capital. You're setting up a business, and then you have bank. So capital on bank, you determine, should capital be credited? Yes, increase in capital should be credited. Increase in bank, so money in the bank has increased as well, so you debit that amount. So please pause the video and do that for each of these transactions. Do that for each of the transaction for practice purpose. Okay, so just to recap, what we've been discussing in this particular video alongside the part one, we're saying, when we're referring to cash, we're talking about the physical money in the business. When we then refer to bank, it means the money has then been deposited into the bank, or we refer to check, it means that there's been a withdrawal from maybe the bank. So if the payment has been made by check, it means there's reduction in bank. If they said money has been withdrawn from bank to put into the PO as cash, there's now more cash even though there's less bank. Credit is obtaining products before paying them. So you haven't paid, you have deferred payment to a future date, to a later date. When we talk about account receivables, that's our customers have bought goods from us, but they haven't paid. They've deferred payment to a future date. When we talk about account payables, it means we have bought things from our suppliers. We haven't paid. We have deferred payment to a future date. And then, of course, our capital, which is our contribution within the business, So the keywords I want us to, look at going forward would be return inwards, good return by customers, return outwards, goods return to customers. So return inwards is, we sold goods to our customers, they return some things back to us. But return outwards is, we have sold goods, we've bought goods from our suppliers, but maybe because there's damage or something doesn't fit, we return it back to our suppliers, and that's return outwards. Carriage is, the products, when we buy things maybe online and all of that, or you've ordered from your supplier, carriage inwards will be when the business, you're charged for the goods you have purchased, the delivery of the goods that you have purchased. But carriage outwards is when we charge our customers for the goods that we have sent out to them. So the delivery processes of the goods we've sent out to them, or the postage or anything, any additional charge on delivering the goods to our customers would be carriage outwards. Okay, so we have prepared, the ledger accounts so far. We'll see that when there are we've seen, how to treat cash inflows or how to treat cash outflows, or if, whichever type of account it is. This is just an example to show us, when there's a cash inflow, we know that we're crediting, we're debiting the cash account. But if there's a cash outflow, so a reduction in cash, we know that we're crediting the cash account. So this just, to show us an example of what we've just done. Now we have multiple transactions here, unlike the one we've just done when we're just posting just individual transactions. So with multiple transactions on each of the accounts, you see the details will be like this. We'll see that as we go forward. The next discussion we're having is balancing accounts. So we have looked at how to post accounts into our ledger, into the ledger. How then do we balance these three accounts, these ledger accounts? So once we have entered in all of these records, how do we balance the accounts? When we mean balancing, it means that how do we get them to become equal? We know we said for every debit that both sides of the account has to be equal, right? So if the debit is greater than the credit side, we have to just look for what's the difference between this side, and we'll put in the balance. So if the debit is greater than the credit, we would have a debit balance, and if the credit is the one that is greater than the debit, we would have a credit balance. So let's see that. We'll look at that as we go on. But if you see that your debit side is greater than your credit side, we've said you'd have a debit balance, but the balance you're going to be putting to the to the other side, we'll call it a balance carried down. So you call that a balance carried down. And then after you put the balance carried out at the end of the period, you then insert a new date below the debit side and put balance brought down. So you put the date of the next period, balance brought down. So carried down is you putting the excess, the difference between both sides, you're putting it in the side that is lesser, and then that balance you're going to bring it down to the subsequent period. So let's see that as an example. So here we have account receivable, ledger accounts. the debit side and the credit side. So you have your invoice 1 is 200 debit side, invoice 2 150 debit side. What it means is that your account receivable increased by 200 and 150. Don't forget, account receivable is an asset account, right? So, and then you have your credit. So it means that, you know, they paid, maybe one of your customers paid the cash of 180. So you have 200 and 150. This should give us 350 pounds, and we have it here. But this is 180. So this is not as, you know, this side, which is the debit side, is greater than the credit side. We have a debit balance, right? So we'll look for the difference between this 350 and 180, and that should be 170. You see now that we call this balance carried down. So balance carried down is 170. If you add 170 to 180, you should now have 350. So both sides are now equal. This balance carried down, you're going to take it to the next accounting period, and then that becomes the balance brought down. So you bring it here as balance brought down. This is what is going to start the next accounting period. So in the next accounting period, we're saying that we have an asset in account receivables of 170 pounds. So I hope that that is, you know, that is clear. So first of all, you sum the parts, you look for the bigger part of it, so which is higher, and then you can then do your subtractions. Okay, so let's look at this example. So you should maybe pause the video and then try it out. You have your bank accounts. We have capital. So it means this you know, person deposited capital, brought in money into the business, but deposited it in the bank. So there's been an increase in bank. And then there was also a bank loan, you know, so maybe money was given in the bank, you got a loan from the bank, and so your bank loan is now, your bank money in your bank account is now 10,000. So if you sum 5 plus 5, this is 10,000. If you look at the credit side of this account, it looks as though, you know, this person had bought a computer of 600, which reduces the amount in the accounts. Pearls Limited, so maybe paid the supplier 200 and then took a little out of their capital. So there was a withdrawal of capital, and that is 50. So if you add this together, this gives you 850 and this gives you 10,000. So 850 and 10,000. So they're not equal. And we said that both sides of the account have to be equal. So you subtract 850 from 10,000, that gives you 9,150, and that becomes your balance carried down. So our balance carried down is now 9,150, because if you add that to 850, it gives you 10,000. Both sides are now equal. And this balance carried down becomes your balance brought down for the next accounting period. So you bring the balance down, 9,150. It means that if, you know, this was January, for example, by the 1st of February, you still have 9,150 in your bank account. So you still have 9,150 in your bank. Okay, so I have put in here some examples for you to practice. You want to pause the video. Here's your capital account. Here, the credit side is, you know, is higher than the debit side. There is a credit balance. Of course, this is capital, and don't forget, capital has a credit balance. Well, unless if as a business you've eaten up all of the capital, which you have a debit balance. But here you have, you know, a credit balance as you should be. But the sides are not equal. This is 5,000. This is 50. So what you want to do is you then want to, you know, solve for the difference, and we should have 4,950 as balance carried down. 4,950 balance carried down, and this also becomes your balance brought down for the next period. So it means that at the beginning of the next period, you still have 4,950 as capital in the business. Okay, so try this again. Furniture accounts, you have a debit entry of 400. Furniture account is an asset account, so you should have a debit balance. So you have Pearl Limited, so it means, you know, you have increase in furniture that you bought from your supplier Pearl. So we have 4,000. So it means that maybe most likely you bought this furniture maybe on credit. If we go to Pearl Limited, we're going to see this amount in their trade receivables account. Sorry, trade payables account, trade payables. So, but this both sides are not equal. So 400, it means our balance carried down here will be 400, and our balance brought down would also be 400. So balance carried down 400, balance brought down 400. Furniture account has a debit balance. Another example, pause the video and try it. So this is Pearl Limited. This is our suppliers account. We had bought furniture from this supplier on credit, 400, and we've paid bank, you know, to this customer 200. If you check the difference, there's 200 debit balance. There's a there is a 200 difference between 200 and 400. So 400 minus 200 is what? 200. So whilst we had bought furniture of 400 from this supplier, we had only made a bank transfer of 200 to the customer. We're still owing this customer 200. So our balance brought down here would be 200, and it becomes our balance brought down for the period. So we're still owing this customer, this supplier 200, which we're carrying over to the next period. Another one. So do you want to pause the video and try? You have your computer accounts. Your computer is an asset account. So we have increase in computer because you bought the computer, using money in the bank, 600. So you balance both sides by what? Having your balance carried down here, 600, balance brought down here, 600. Simple. Balance carried down, 600, makes them both equal. And then you have your balance brought down. So it means the beginning of the next period, you know that in your computer, you have computer that is worth 600 in assets. And finally, let's look at this one. So we have account payables accounts. So you have your cash, 5,000, purchases 5,000. So here you see that this is the account payables. When you bought things from your supplier on credit, account payables is a liability account. You're owing. So you bought on credit purchases from your customer, you didn't pay, that was 5,000. But later on, you paid cash to this same supplier of yours, and that nils the balance. Now that there's no excess, there's no difference. So they're both the same. And we said our debit side, our credit side needs to be equal, right? And they are both equal. If you knew them, they're zero. So there's no closing balance because you're not owing your supplier anything again. So there's no balancing. There's no balance is needed in this case. No balance is needed. There's nothing for you to balance off in this case. Okay, so when we say if the balance carried down appears on the right side of the account, we call this a debit balance. So if it appears on the right side of the account, we call it a debit balance. But if it appears on the left side of the account, we call this a credit balance. So what I mean by that is this is appearing, your balance carried down here is appearing on the right side of the account. This is a debit balance. If it appeared here, it would have been a credit balance. And all of these accounts that we have created in our T accounts, in our ledger accounts, is what then makes up the trial balance. So a list of all of those balances. So once we have, drawn up our T accounts, our ledger accounts, and then we balance them, those balances is what makes up our trial balance. Is what makes up our trial balance. Okay, so I'm leaving this one for you to be able to do an example. So for your individual tax, you can try to balance up these accounts. So you have XYZ Limited, and you have these transactions that have taken place. All you need to do is sum this as well, and then subtract. If this is bigger than this, so in which case it should be, here we have 1,600 and here we have 500. So if we have 1,600 here, so all you need to do is come here, write 1,600. Okay, so we have 1,600. Here we have 500. So it means that the balance here is 1,100. 1,000. We have 1,600 here. So we have here 1,100. And this becomes our balance carried down. So this becomes our balance carried down. And then here we'll come here and we'll say our balance brought down. So our balance brought down, which will become 1,100. 1,100. And I hope this is clear. So you can use this. So you can pause the video and try this. Here you can see that there's no transaction here at all, right? So all you just want to do is sum this up. You want to sum this up. This should give you 1,800. So you have 1,800. You write it properly. And then you come here and write 1,800 as well. 1,800. So you write that properly when you're writing it. And here you have your balance brought down. Your balance carried down. So let it be your balance carried down 1,800. 1,800. And you can then have your balance brought down here. Balance brought down. And then that will be 8,800. And that's because in your purchases account, everything you bought was on credits. So you still have, sorry, in your purchases account, forgive me, in your purchases account, you did not return anything back to your supplier. So your purchases account is an expense account. Your purchases account is an expense account, and that's why your purchases account you're debiting, right? So you bought all of these for 1,008, you didn't return anymore. If you had returned, so if there had been a return outwards, for example, yes, then that would have reduced the value of your purchase account. But in this example, there was no return outwards, so there was no credit. Note that your purchase account is an expense account, and that's why you debit it. Okay, so try that. Try this as well. I'll leave you to try this. Try this. You sum up this. You also sum up this. This should give you 600. And if you add up this together, it's also 600. So there's nothing to, to balance. So everything is 600, 600, 600, 600, it is balanced. 600, 600, it is balanced. So if you add 250 plus 200, that's 450, plus this is 600. 250 plus 350 is also 600, and that's it. Okay, try this as well. 1,000, 1,000. I think that should be straightforward. And then we'll end with this example. So try this and balance this account. So far we've looked at, how to post accounts into the accounts, into our ledger accounts, and how to balance those accounts. And those balances is what would then form our trial balance. I hope this is clear. I'll see you in the next video.